Hi, everyone. I'm Matt Clark, research analyst with Money and Markets, and joining me as he does each and every single week, and he muddles through it every week, and I got to give him credit for it, and that is Charles Sizemore, Green Zone Fortunes co-editor. It is time for another episode of Investing with Charles. Charles, thank you for joining, and let's dive right in. Obviously, one of the big topics on everyone's mind, whether you're an investor or not, and that is inflation. And I don't want to really get too deep into inflation because basically, the cost of goods are going up. There you go, inflation. The power of the dollar is not nearly what it was. It isn't as much as it was last year.
A year ago?
Yeah, last year.
A week ago?
Last year, the dollar would buy you more than it does today. That's inflation. There you go. Very simple terms. But when it comes to investing, especially as a dividend investor, which is really your forte. That is. You're good at a lot of things, but when it comes to dividend investing, I always look to you to guide and to give ideas in terms of what people should look for. So what I want to do today is I want to talk about inflation and dividend yield and understand that all is not the same when it comes to dividend yield, especially when you factor in inflation. So I want to start there. I don't want to get into inflation. I want to focus more on dividend, on what smart investors like our viewers should be looking for when they're trying to outpace inflation with dividend. If that makes sense. Does that make sense?
It makes perfect sense.
I'm glad because I
speak Clarkese. I speak the language of Clarkese here.
That's good. But, I'm glad somebody.
I'm fluent in it. Yeah. It took years of study, but we got there. But so in a nutshell, if you're living on a fixed income or you're living on and fixed income could be a pension payment, Social Security, bond yields, dividends, any of that. The issue is if your income stream is not growing at least as fast as rate of inflation, you get poorer every year. Your purchasing power goes less far. So, a lot of investors make that mistake of just focusing on current yield. They say, this bond, this income investment, this fill in the blank, whatever it is, this pays me 5, 6, 7% today. The issue is that may sound like a really high yield, but it's going, that actual, the purchasing power of that payout is going to be tongue-tied today. Is going to decrease in value with every past year due to that just kind of sandpaper effect of inflation. So you want things that pay a respectable yield today. You could even accept kind of a lower yield than what you might consider ideal today, so long as there's growth there. That a little bit smaller payout today for the promise of a higher payout tomorrow. And we're not talking about capital gains; those are also nice. But we're talking about just the actual dividend. We want investments that increase that payout every year. So this introduces the concept of yield on cost. And I really like this. It is a backward-looking metric. Most metrics in fundamental analysis are, unfortunately, but it does give you a good kind of mental exercise here of what would have been. And it doesn't necessarily give you perfect visibility on future dividend growth. You have to do your own homework on that, but it does give you kind of a nice snapshot of at least what the stock has been capable of doing in the past. So yield on cost takes the dividend today and divides that by your original purchase price, however long ago, last year, 2 years ago, 10 years ago, infinity years ago. Just whenever you initiated the position, it takes that dividend today divided by your original purchase price for the yield. And if that dividend has been rising every year, the share price could go up, it could go down. That's not relevant in this case if we're just buying the stock for the income stream. But that gives you a good indication of kind of what that growth has been like. So as an example, let's look at two kind of dividend stalwarts, if you will. We'll look at a blue chip utility and a blue chip REIT to get the kind of the lay of the land here. And so Duke Energy is a portfolio that should be really no stranger to any income investor. It's one of the largest utility companies in the world. It's a good dividend payer. Realty Income is also an excellent dividend payer. It's been around forever, and it's a very conservative retail REIT. They own things like convenience stores, gas stations, things like that. Both of them today pay very comparable yields. Do you have those numbers in front of you by any chance?
I do, actually. If I look and the yield percent, we'll go by percentage, not by dollar amount. So right now, the dividend yield for Duke Energy, its yield percentage is right at 3.79%. And then if we look at Realty Income Corp, ticker symbol's O, the current dividend yield there is 3.85%. So they're very, very close in proximity to one another.
Right. Let's just round and say they're both the same right now. So you might look at this and say, well, okay, I mean, they both yield about the same. One's probably as good as the other, is kind of a long-term dividend holding. But go back 10 years. If you look at that yield on cost from a 10-year yield on cost. So if you had bought this stock 10 years ago and you compare today's dividend to your purchase price 10 years ago, accounting for all the dividend growth that has happened between then and now, you get a very different picture. When one stock has a higher growth rate, it compounds over time. It snowballs. So it may not matter that much in the first year. You may not notice. You may not really notice even after 3 or 4 years. But when you get to that 10-year mark, that compounding really starts to kick in. So drum roll, we need to have special effects drum roll. What is that 10-year yield on cost for Realty Income today?
I'll tell you now that if you had bought Duke 10 years ago, it would yield 4.9% based on today's dividend. And
that sounds pretty good, right?
It does. That sound. You're like, wow, that's actually really good.
That's pretty competitive in today's market.
Let me throw a wrench.
But long pause here.
Let's throw a wrench. If you did the same with realty, with O, that number goes to 6.9%. So now you're looking at a much bigger difference. Right now, today's yield right around that 3.8% range. But if you look at it over a longer period of time, like most, you're holding these dividend stocks for longer periods of time. These aren't, turn it and burn it. These are ones that you're going to hold for a while.
And by the way, 10 years sounds like a long time, but it's really not. No. Not when you're in or near retirement. It goes by in the blink of an eye. So you're talking about a yield pushing 5 versus a yield pushing 7. That's a significant difference.
Yep.
And I don't see that slowing down. There will be years where Realty Income doesn't raise its dividend by as much, or Duke may raise by more. It can vary from year to year, but over time, one stock has clearly proven to be a more aggressive grower than the other, and again, it compounds. And so, when you're looking to put together an income portfolio that will withstand the ravages of inflation, it's something that will that will survive that and keep you at least equal to, or ideally far ahead of, rising prices. You really need to focus on dividend growth. It's vastly more important than high yield. I love high yield. I love getting that high yield today. It's that instant gratification. It's fantastic. But if you're really looking out for your retirement here and you're looking, for that next step, dividend growth is vastly more important.
Yeah, there's a lot of components to dividend. A lot of people, I think, just tend to look at what's the percentage, what's the payout, how much am I going to get every quarter when, or what's the forward annual yield? What am I going to get? And they're
what's my yield today?
Yeah,
it's 5%. Great, let's go.
They're looking at it today.
That extra. Yeah,
but exactly. Just like with anything else, you've got to kind of plan ahead, especially if you are in an income. If you're in the market for income, like dividend investors typically are, you've got to be, you can't be thinking of the today. You've got to be thinking of the 5, 10, 15 years from now. What am I going to be looking at then? Because
you don't want to move in with your kids in old age, and you don't want to eat cat food.
Yes, on both counts. on both counts. You don't want to live with your kids, and cat food should not be on the
Have
menu.
you seen the price of cat food? Cat food's expensive now. Even that's going up. You may not even be able to afford that if you don't keep pace with inflation.
Exactly. So it is important.
If it's organic, if it's farm to market, organic cat food. I mean, you're in trouble.
Yeah, animals are eating better than we are, at least price wise. So dividend on cost is definitely something that income investors need to pay attention to. You need to understand, okay, what's the dividend growth? What are we looking at? How has this company grown its dividend? Have they done it nice incrementally? Has it had good pace? It's not like a one shot straight up and then we move it back down again. Are they gradually paying their investors over a period of time? And is that growth manageable, especially when I compare it to the rate of inflation? And those aren't the only metrics to look at, Charles. I think it's important to understand that, when it comes to dividend investing, again, it's not just as simple as seeing what the forward yield is. What am I going to get today? There's a lot of factors involved. And
you need to consider the health of the company. At the end of the day, what is the dividend? The dividend is a profit distribution. So you need to be sure that the company you're buying is healthy and continuing to generate the profits needed to support the dividend, of course. But today with inflation, what it is, purchasing power, that sandpaper effect of rising prices, the yield on cost, that dividend growth is particularly important.
Yeah, and it's important to also point out that both of these companies, one being a REIT, one being a very strong utility, these are both very good companies. These are both very profitable companies. REITs have a requirement to pay out, whereas Duke has done so for years. They continue to grow. They are a very strong utility, primarily in the Southeast. They are based in Charlotte, by the way, but they are in Florida. They also are all venturing up north. They are a very strong utility, one of the bigger ones here in the United States. So these are both very good companies. And if you're looking just on a broad look at investment, either one of these companies would be great for a portfolio. And if you're a dividend investor, both of them would be just fine. But if you're looking for specifically, I want to make sure that my income that I get does outpace the rate of inflation, then you have to kind of skew a little bit more towards realty, towards O, because they do have a much better dividend ratio to cost. So it's just something you have to look at, and it's a little bit of simple math. But again, at the end of the day, you're going to wind up paying yourself more in the long run, and your dollar is going to wind up going a lot farther if you're looking at these dividend stocks that have solid growth over years, as opposed to just kind of settling for what there is today.
I agree.
Anything else on
what you said?
Anything else yield on cost, Charles, that we need to know about?
No, I would just add, this is one of the many topics that we do tend to discuss in money and markets on a regular basis. We don't only discuss dividend and income investing, but it is certainly a very important arrow in the quiver.
And he is the dividend expert. So if you are looking for any information related to dividends and stocks that pay dividends, Charles Sizemore is the go-to guy. He knows the stuff. He's who I rely on because he knows a heck of a lot more about it than I do, and he's got a good plan in place and knows the stuff. So Charles Sizemore, co-editor of Greens on Fortunes, thank you for jumping in and joining us for another edition of Investing with Charles. I would encourage everyone check out moneymarkets.com each and every day. Charles, myself, Adam O'Dell, our entire team, we provide you safe, sound, smart, simple, profitable investment information for your portfolio. You can get it sent to your inbox for free every day, including Saturday and Sunday, because we don't want Charles to take days off. So we do make sure he is working every day. And then I would also be remiss if I did not mention our premium investment service, that is Green Zone Fortunes. Charles, Adam, myself, our team, we give you a ton of analysis, a ton of insight, and we give you that one stock pick every month that we are solid and very, very firm on is going to beat the market 2 to 3x over the course of a 12-month period. And you can get all that information and access to Charles and to Adam and to myself. You can get all that for less than a cup of coffee, less than the cost of a cup of coffee, and it is yours for the taking. So we'll put a link up there up top somewhere. Make sure you can get information on more information on Green Zone Fortunes. And also, if you do have a comment or a question that you'd like to ask Charles, myself, or Adam, do so. Email us feedback@moneymarkets.com, or you can comment down below here on our YouTube channel. We take those as well. So for Charles Sizemore, co-editor of Green Zone Fortunes, I am Matt Clark, research analyst for Money and Markets. I hope everyone has safe trading.